Hello, everyone, and welcome back to the SICK podcast, where we talk all things SICK about the economy. This podcast is hosted by the Student Investment Club, and I'm your host, Isabela Gonzalez. Today, we're switching things up a little, and instead of just vibes and headlines, we're breaking down a research article from Mikita Investment Group on frontier markets, basically the in-between markets that aren't quite developed, aren't quite emerging, but are investable. So, what are frontier markets? Frontier markets are countries with stock markets that exist and can be invested in, but they're smaller, less liquid, and less mature than emerging markets in Brazil and India. Think of them as the earliest stage of global investing. These countries often have young growing populations, fast economic growth, but have limited infrastructure and weaker financial systems. The article focuses on the MSCI Frontier Market Index, which tracks a few hundred stocks across 25 to 30 countries. And one key thing to know is that the index is highly concentrated, meaning a small number of countries make up a large share of it. And so, how does the frontier market club keep changing? Another big takeaway is that frontier markets change constantly. Countries can graduate to emerging markets as they develop or get removed if trading becomes too difficult or currencies break down. Over the past decade, many Middle Eastern countries moved up, and today the index is more heavily concentrated towards Asia and parts of Europe. So, growth sounds great, but here's the catch. Frontier economies often grow faster than the US in terms of GDP. The country itself is expanding, but the article shows that the company profits haven't grown nearly as fast. In plain English, just because a country is growing doesn't mean the companies you invest in are making more money. The US is almost the opposite, slower economic growth, but very strong corporate earnings. Performance and diversification is not a safety net. Another myth the article breaks down is that frontier markets are not a great crash protection. During major downturns like the 2008 financial crisis, COVID-19, recent rate hikes, frontier markets still fell hard, sometimes even harder than developed markets. So while diversification exists, it's limited. So why are frontier markets riskier? There's low liquidity, making it harder to buy and sell. There's currency volatility, meaning that returns can vanish when currencies weaken. And there's weaker governance, which provides less investor protection. In short, markets are harder, riskier, and more expensive to invest in. So, why would anyone invest? Here's the most important takeaway. Because frontier markets are inefficient and less researched, active managers have historically done much better here than passive index funds. According to the article, frontier market active managers outperform their benchmarks by much larger margins than managers in the US or developed markets even after higher fees. If frontier markets work at all, the paper argues they work best with skilled active management and not set and forget investing. And so, what is the bottom line? Frontier markets aren't just about the hype, they're about selectivity, patience, and execution. Thank you for listening to the SICK podcast, and as always, stay curious, stay informed, and stay sick.